Imagine two businesses, both earning $1 million in profit, but which one is actually doing better? In this video, we'll find out how to analyze accounts to understand a company's real financial performance. You will learn what profitability and liquidity mean, how to calculate key ratios, and how different people, from managers to investors, use this information to make decisions. The concept and importance of profitability. Profitability shows how effectively a business turns its sales or investment into profit. It's not just about how much money is made, it's about how well that money is earned. Businesses often compare profitability ratios over several years to track improvement or decline. For investors, higher profitability means the company is more attractive. For managers, it helps them identify which products or strategies are performing best. Next, the concept and importance of liquidity. Liquidity tells us whether a business can pay its short-term debts, for example, wages, rent, or supplier payments. A highly liquid business can easily turn its assets into cash, but if liquidity is too low, it may struggle to pay bills on time. On the other hand, too much liquidity can mean the business is holding unused cash instead of investing it productively. Now let's talk about profitability ratios. They help us measure how effectively a business earns profit compared to sales or capital invested. These ratios show whether the company's performance is improving or not. We'll begin with the first one, the gross profit margin. Gross profit margin measures how much profit is made before other expenses are deducted. It's calculated by dividing gross profit by revenue, then multiplying by 100. Gross profit itself is found by subtracting the cost of goods sold from total revenue. Let's take Bella Fashion as an example. The company made $80,000 gross profit from $2,000 in sales. If we calculate gross profit margin, it equals to 40%. This means for every $1 of sales, 40 cents is gross profit. A higher gross profit margin indicates better control over production costs or higher selling prices. To improve this ratio, businesses can reduce costs, find cheaper suppliers, or increase prices if customers are willing to pay. Net profit margin. Net profit margin shows how much final profit is made after all expenses, such as rent, wages, and interest, are deducted. It's calculated by dividing net profit by revenue, then multiplying by 100. Let's continue with the same business. After paying all expenses, Bella Fashion earned $30,000 net profit from $2,000 in sales. From the formula, we get 15%. So for every $1 of sales, the company keeps 15 cents as net profit. A higher margin means better cost control, while a lower one suggests rising expenses or falling sales. Compare net profit margins with previous years helps managers see if efficiency is improving. Next one, return on capital employed. Return on capital employed shows how effectively a company uses its total long-term capital to generate profit. For example, if a company invests $1 million and earns $250,000 profit, its return on capital employed is 25%. This means every $1 invested earns 25 cents of profit. A higher return on capital employed indicates strong performance and better use of resources, which is very attractive for investors. It also helps compare one business with another in the same industry. Now let's talk about liquidity ratios. The first one is current ratio. The current ratio compares current assets like cash and inventory to current liabilities such as wages and bills. It shows whether the business can pay short-term debts using its current resources. The formula is current assets divided by current liabilities. For example, if a company has $15,000 in current assets and $10,000 in current liabilities, then current ratio equals 1.5. This means the company has $1.5 of current assets for every $1 of short-term debt. A ratio between 1.5 and 2 is considered healthy. Below 1 indicates possible liquidity problems, while above 2 shows that too much money is tied up in unproductive cash or stock instead of being invested back into the business. Next, acid test ratio. The acid test ratio goes one step further. It removes inventories because stock takes time to sell and it is not immediately available to pay debts. This ratio shows whether a business could meet its short-term obligations using only quick assets like cash and receivables. The formula is current assets minus inventories divided current liabilities. Let's calculate an example. If current assets are $10,000 and inventories are $2,500, then liquid assets equal $7,500. Now divide by liabilities of $10,000. Asset test ratio equals 0.75. This means the business can pay only 75% of its short-term debts immediately without selling any stock. A result close to 1 is ideal. Below 1 means liquidity problems could arise, especially if inventory is slow-moving or difficult to sell. Now let's see why and how different groups use a company's financial accounts. Each stakeholder looks at them for different reasons, to evaluate profitability, stability, or future prospects. Let's look at them one by one. Managers use company accounts to keep control of performance across departments. They analyze ratios to identify strong and weak areas, compare current results with past years, and decide whether improvements are needed. This helps them make informed choices about pricing, costs, and future investment. Shareholders look at profitability and liquidity ratios to judge if the investment is performing well. They compare results with other companies and decide whether to buy more shares, hold them, or sell. If profits or return on capital employed increase, shareholders are more confident about the company's performance. Banks analyze liquidity ratios before giving loans. If the company's current and asset test ratio is low, banks may see it as a repayment risk. Healthy liquidity reassures lenders that the business can pay interest and installments on time. Next, suppliers. Suppliers often sell goods on credit, so they study a company's liquidity ratios to ensure it can pay on time. If the figures show liquidity problems, they may reduce the credit period or demand cash payments upfront. Government. Governments use published accounts to collect accurate tax payments and monitor economic health. Falling profits or frequent losses might signal risk to jobs or future tax revenue, prompting government attention. Workers and trade unions. Workers and trade unions look at accounts to understand whether their jobs are safe and whether the company can afford pay increases. If profits are falling, unions might prepare to negotiate or protect employees from layoffs. And the last one, other businesses. Other businesses, especially competitors, use accounts to compare profitability and liquidity. They might use this information to improve their strategies or consider merging or taking over weaker firms. To summarize, profitability ratios tell us how efficiently a business earns profit. Liquidity ratios reveal its short-term stability, and together they help stakeholders make better decisions. I hope this lesson was helpful. Don't forget to like and subscribe and visit the channel for more videos. Bye bye.